Hello and welcome. Thanks for joining this discussion, which has been arranged for you by the specialists over at Pro Tax Accountant. Today, we're going to get into a really critical topic for UK landowners, capital gains tax. What are the rules, really, when it comes to agricultural land? It's actually one of the biggest and, let's be honest, highest stakes questions they get from their clients. So we're going to break it all down for you, step by step. All right, let's dive right in. The question itself seems pretty straightforward, doesn't it? But wow, the answer has some massive financial implications. So, is agricultural land actually exempt from capital gains tax? Okay, the simple, straight-up answer is no, it's not. In the UK, agricultural land is not automatically exempt. But, and you'll want to listen closely here, that is absolutely not the end of the story, not by a long shot. See, the real conversation isn't about exemption, it's about management. It's about being smart. The real key here is understanding all the powerful reliefs and strategies out there that can seriously reduce, defer, or in some cases even totally wipe out your final tax bill. Okay, so first things first, let's do a quick reality check on what this tax actually is. So what is capital gains tax, or CGT, anyway? Well, at its heart, it's just a tax on the profit you make when you sell or get rid of an asset. It's super important to remember it's not on the total price you sell for. It's only on the gain. That's the difference between what you paid for it and what you sold it for. And the numbers here really matter. For the 2024/2025 tax year, if you're a basic rate taxpayer, you're looking at a 10% rate. But if you're a higher rate taxpayer, that rate doubles to 20%. And that can be a huge chunk of your profit, right? And here's something that really adds a sense of urgency. The annual tax-free allowance, it's been slashed in half. It's gone from £6,000 down to just £3,000 from April 2024. That move alone makes getting your planning in order more important than ever. So, okay, the allowance is shrinking. What do? How do you protect your assets? Well, it all comes down to knowing what's in your financial toolkit. And the most powerful tools in there are the key tax reliefs. We're going to focus on 4 absolutely essential reliefs that you really need to get your head around. Some of them will lower your tax rate, while others can actually push the tax bill way down the road. So let's break them down one by one. First up, we have Business Asset Disposal Relief, or BADR for short. Honestly, this one can be a total game changer, especially for farmers thinking about retirement. If you qualify, it can slash your CGT rate down to a flat 10% on gains up to a lifetime limit of £1 million. But here's the catch, and it's a big one. You have to have owned the business for at least 2 years leading up to the sale. Next up, rollover relief. Now, this one doesn't make the tax disappear, but it lets you kick the can down the road, so to speak. Basically, if you sell a business asset and then reinvest all the proceeds into a new qualifying asset within 3 years, you can put off paying the CGT. It's an amazing tool for farmers who are looking to, say, move or restructure their operations without getting hit with a huge tax bill right away. But what about your farmhouse? The place you actually live? That's where Private Residence Relief, or PRR, can come into play. This can exempt the gain on your main home and your garden from any tax. But a word of warning, HMRC scrutinizes these claims very carefully. The farmhouse has to be what they call of a character appropriate to the farm to get the full relief. And last but certainly not least, we have holdover relief. And let me tell you, this one is absolutely critical for anyone thinking about succession planning. It basically lets you gift the farm to the next generation without triggering a big, immediate tax bill. The tax is just held over until your kids or grandkids decide to sell the asset themselves way down the road. Okay, so knowing the tools is step 1, but putting them together into a coherent, smart strategy, that's the real trick. So let's look at how you can actually put all of this into practice. So a really proactive plan has 4 main steps. First, you've got to maximize every single allowance you can. That includes your own and your spouse's. You can even transfer assets between each other tax-free to do this. Second, be efficient. If you have any capital losses from the past, make sure you report them to HMRC so you can use them to cancel out your gains. And finally, it's all about looking to the future. Use those incredible tools like holdover relief to plan for succession and protect your family's legacy. Now, that all sounds pretty straightforward, right? But in reality, the rules can be an absolute minefield. And that brings us to a really, really important point: why getting expert advice is so often not just a good idea, but essential. Just think about this for a second. Imagine you have land with development potential. If you make one wrong move, HMRC could decide to reclassify your profit. All of a sudden, you're not looking at a capital gain taxed at 20%, you're looking at trading income taxed at a whopping 45%. The financial difference is just enormous, and it really highlights the risks of trying to navigate this all by yourself. So here's the bottom line. Yes, the tax rules are complicated, but they're not impossible to navigate. The key to everything is strategic, proactive planning. That's how you protect the value of what you've built, and it's how you secure the legacy you've worked so hard for. At the end of the day, the future value of your land really comes down to the decisions you're making right now. For advice that's tailored specifically to your situation to make absolutely sure you're making the right calls, the specialists at Pro Tax Accountant are there to help guide you through every single step. All their contact details are right there on the screen.